Now let's talk about the risk. And risk is a very different thing to different people. Like in real life, the same would see here in investing. And first of all, there's a risk of simply not getting your money back. For example, that government that you lent your money to, or that corporation that you lent your money to, will go bankrupt, and your hard savings would simply disappear. Or that stock that you bought, that company will go bankrupt, and that stock, that basically usually the price of that stock will also go to zero. So that's very understandable measure of risk. Another measure of risk might be the variance of results. For example, if the average, let's say, stock market return is 7%, that's an average. This means that it can be 0 one year, it can be 14 next year. On average, it's 7. And it's really a problem if you need 7% return every year. If you depend a lot of this, getting this 7% every year, or if you cannot wait, let's say, for 8 years, you will have 0 return, and suddenly you will have 100% return. On average, this again is like 7%, but you simply cannot wait for this year number 10. So this variance of the results is a real risk it might be very real risk for somebody, and definitely is for you if you are expecting something and not getting back what you expected. And finally, there's a risk that, well, you can always say, okay, I can withstand this, like 0 return, then 14% return. It's still possible positive return, but sometimes the return might be negative for a couple of years, and after a certain period of time, or the price of your asset might go down. For example, you bought a house, and we were talking about that, yes, it keeps up with inflation, the prices usually go up, but what if not? What if for that particular decade it went down? So again, it's a risk. So we can make a slope, make a chart where we have a slope. And this is one of my thesis that I want you to understand. There's no additional return or good return without some risk. There would be some risk somewhere. Maybe that's a risk of not getting your money back. Maybe it's a risk of the promised return. Maybe it's a risk that the price would not appreciate over the time, but it would depreciate over the time. So we have this upgoing slope where it says the more return you have, the bigger is the risk. And for example, if we are talking about the variation of the yearly return, it might look something like this. We have an average return that is going up with the risk, but risk in this case, for example, the third, this green bar, just shows that sometimes, yes, on average, the return is better than in the return for the first bar, let's say the first asset. But that's on average. Sometimes it can be easily negative with some low probability, but it can still happen. So I will try to plot all these saving types over here with an average return and increasing risk. We will start with saving accounts. Usually, at least over the last decade, those were the numbers. Saving accounts gave you 1% yearly return, and they are considered, let's say, zero risk. That's your risk-free return of 1%. Then a little bit more of the risk, but definitely higher the return. Governmental bonds, they are something from 3 to 4% return. Then there are corporate bonds. They usually give you about 5% return. So yes, the return compared to the governmental bonds is higher, but the risk is higher also. Risk of not getting your money back, risk of something bad happening. Then there is S&P 500 stocks. Those are the 500 biggest stocks in United States stock market. United States stock market is the biggest stock market in the world. Probably it makes around half of all the world combined stock market, and those are the 500 biggest corporations. So basically this is the benchmark for investing into the stocks, and the return is from 6 to 7%. Then there is high yield bonds. They are called very interestingly either high yield or junk bonds, and usually these are the bonds from the corporations that are rated as very, very risky. The corporations might be big, but there's a huge or let's say bigger risk of not getting your money back. That's why they need to pay higher cost of money, the higher yield towards the lenders that agree to lend them the money. Then there is small stocks, and usually the smaller stocks, for example, from your local market, if you are not living in States, or if you are living in the States and the stocks are way outside of these 500 biggest corporations, they on average would have a bigger return, but definitely higher risk. Then there is real estate with yet higher return and higher risk. And finally, there are all those venture capital, startups, and all these activities that have even higher returns, but definitely, again, higher risk.